Hello traders, and welcome back to the Forex Geek, where we dive deep into the tools that can help you make smarter trading decisions. In today's video, we're going to explore the Fibonacci MACD strategy, which is a method that combines Fibonacci retracement levels with the MACD indicator to identify precise trade setups. So stay tuned as we break down how these tools work together and guide you step by step on using this strategy effectively. Watch to the end to avoid common mistakes and refine your approach. So first of all, let's define the Fibonacci and the MACD indicators. The Fibonacci MACD strategy is a trading approach that combines two essential tools: the Fibonacci retracement levels and the MACD indicator. So the Fibonacci retracement is used to identify key levels where price may reverse or consolidate. This is the Fibonacci retracement. These levels, the 23.6, 38.2%, the 50%, the 61.8%, 78.6, and 100%. They are all derived from the Fibonacci sequence, and they act as potential support or resistance zones. And by plotting these levels between a swing high and swing low, you can anticipate where the market might react. So the next indicator in this strategy is the MACD indicator, which is this indicator below. We are all familiar with the MACD. This indicator complements this strategy by analyzing price momentum and trend direction. It consists of MACD line, the signal line, and histogram. We have the MACD line, which is the blue line, the signal line, which is the orange line, and the histogram bars, which is this green bars right here. Have these green and red bars. These are the histogram bars, and we use the MACD to identify crossovers, divergences, and momentum shifts. So for instance, when the MACD line crosses above the signal line, it signals bullish momentum. When it crosses below, it indicates bearish momentum. So together, these tools create a strategy where Fibonacci levels highlight potential price zones, and the MACD confirms whether momentum supports a trade at those levels. So I'll show you exactly how to use this strategy and how to trade with this strategy. It's a very simple strategy. You will learn it in the next few minutes. So for example, if price retraces to the 50% level in an uptrend and the MACD shows bullish momentum, this could signal a buying opportunity. So to apply the Fibonacci MACD strategy effectively, you start by identifying the market trend. Are we in an uptrend? Are we in a downtrend? Or are we in a ranging market? For example, on this chart, you can see that we are in an uptrend. So the first step is to identify the overall trend. You can see that we are in an uptrend here, and I'll just look for a swing low to a swing high. We have price breaking structure here. So this we have here is a swing. Here is a swing high, here is a swing low, and this is where we'll have our Fibonacci. We'll plot our Fibonacci from the swing low all the way to the swing high, and this is your Fibonacci. So the first step is identifying the market trend. Are we bullish? Are we bearish? Then the next step, once you've identified the trend, plot Fibonacci retracement levels just like I've done. In an uptrend like this, draw these levels from the swing low to the swing high. And in a downtrend, reverse this by plotting from the swing high to the swing low. So focus on key levels such as the 38.2%, the 50%, the 61.8%, and the 78.6%, as these zones often act as zones where price reacts. Next, you use the MACD indicator to confirm momentum at these retracement levels. Look for crossovers or changes in the histogram that align with the price action at these zones. So for instance, you can look at this chart. We have price reacting at the 61.8 level here. Price reacted at the 61.8 level here. Actually, price reacted the first time, but then we had another reaction here. So let me quickly go over this. So after we've plotted our Fibonacci, you can see price reacting to these levels, but the MACD is not confirming these bullish signals in which we are having from the Fibonacci. For example, you can see that the MACD is giving us a bearish momentum. We have the MACD line below the signal line, which shows that we are bearish. Even as we've approached the 50% and the 38.2%, but the MACD shows that we are bearish, so we can't take any buy trades. So when we finally had the buy trade, the buy signal is here, where we had the crossover first. We have the crossover. We also had the green histogram bars, the bullish histogram bars. We also have the moving averages going above the 50 level, and this shows us that indeed we are bullish, and the MACD has given us the buy signal, and also this coincides with the 61.8% level at the time. So we can look to take our buy entry from this area. Also, you can use additional price action or candlestick patterns to confirm your trades. Here we can see the 3 inside up candlestick pattern, which is this red candle, a green candle followed by another green candle which closes above the first candle's high, as you can see right here. So that's a 3 inside candlestick pattern, and also you can see an FVG forming right here, and price is reacting off of that FVG here. We are still bullish. So these are just areas where you can use to take your buy entries. You can take one here, or you can take one here also, and your stop loss should be placed a little bit below that swing low, and your take profit at the 0%. And that's how to trade using the Fibonacci and the MACD indicators. So this is the Fibonacci and the MACD trading strategy. And let's look for another example, preferably a bearish example. And you can see this, we are in a clear bearish trend. Remember, the first step is to identify the market trend. We are in a bearish trend here, and you can see, you can plot our Fibonacci. I'm gonna plot another one here, and I'm gonna plot another one right here. We are bearish, so, and also I need to plot another Fibonacci here. These are swing highs to swing lows, swing highs to swing lows. So here we have our Fibonacci showing us that price should retrace to either the 61.8%, which is the golden zone, and we should be expecting the 61.8% or the 50% Fibonacci level. And looking at this, we don't have a direct indication to sell, because price is still above the 50, the MACD is still above the 50 level, the 0 level, and we also have green histogram bars right here showing that buy signal, showing us a buy signal. So we shouldn't be looking to sell. So as you can see, we still have price ranging around this area, around the 61% area. And finally, we have the confirmation to sell. We have the red histogram bars, we have the crossover here also, we have the cross below 0, the MACD line and the moving average crossing below 0, showing us that yes, we should indeed be selling. Also, looking at this, we can try to see if we see candlestick patterns. We have this pin bar right there, this bearish pin bar, showing us that yes, we should indeed take our sell trades. We have another one here also. I have series of rejection candles. This series of wicks there indicates that yes, we should be selling from this area. This is a valid zone. Also, we have a market structure shift right here. So this is another block which you can use to take your sell trades. So any of these price action strategy that you're familiar with, they all say the same thing, that we should be selling, and our stop loss should just be above the high, and our take profits should be at this level. I'm just going to remove this Fibonacci. Our take profit should be at this level right here, and this is the 0%. So that's how we are able to take our trades based on the Fibonacci MACD trading strategy. So let's look at another example before we call it a day. Actually, I like this example right here. Just quickly draw the Fibonacci level from the swing high to the swing low. So we have the 61.8% here, we have the 50% here, and also we have the 38.2% right here. And at this time where we have price reacting to these areas, we have the crossover here, and we have our red histogram bars here. As you can see here, we are having green histogram bars and a crossover to the upside, so we shouldn't take any sell trades. And this was the exact time we had this engulfing, but it doesn't exactly align with our MACD, so no trades. So our MACD now give us a confirmation here with the red histogram bars and the crossover to the downside, so we should be looking to take sell trades upon the close of that next candle right here, with our stop losses above this high. Just look to just join in the trade. Remember, always trade in line with the current trend so that the market won't go against you in a flash. And we just take 1:2, and that is how we're able to take this trade. Very simple. So for take profits, use previous highs or lows or Fibonacci extensions levels like 127.2% or 168.8%. So looking at this, just gonna add the 168.2% and the 127.2%. So these are the extensions. You can use these extensions for your take profit levels. If you want to take profit from here, you could just draw this the other way and you're gonna see the extensions. You can see where you can take profit, and you can take profit at the 161.8% level, just like this. So that's for your take profits. So this step-by-step approach helps you align technical precision with market momentum, creating well-structured trades that follow clear rules. Alright traders, you've come to the end of the video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, don't forget to like, subscribe, and turn on the notification bell so you never miss out on more trading tips and strategies. Thanks for watching, and I'll see you in the next video.